What's up everybody? Gen X Dividend Investor here. In this preposterous video, I'll tell you the fastest way to make $1 million from dividend penny stocks, which every investor should obviously be dying to know about. So if you're a terrible investor who is looking for get-rich-quick schemes, then sign up for my course using code STONKSONLYGOUP and hit the thumbs down button, unsubscribe, and format your computer. Now, the fastest way to make $1 million from dividend penny stocks is to first start with $2 million, then gamble your money into garbage penny stocks, and voila, you'll end at $1 million, probably within the year. You're welcome. Now, don't be a baby and cry about my awesome April Fool's joke. I mean, babies born on March 31st are the easiest to prank. They were literally born yesterday. Boom, dad joke. I don't always joke on April Fool's Day. Just kidding, I do. Seriously though, what's going on with oil lately with so many new people jumping into it? Which reminds me, did you hear about the guy who swapped the labels on the pumps at the gas station? It was an April Fool's joke. Get it? No? Don't worry, I don't need a day for April Fools. I'm a fool all year round. Okay, now some real data. Take a look at how the energy sector has been performing. I sorted this based on which sector had the best returns in the last 12 months, and we see that energy is absolutely killing it with 62% returns. The next best sector is tech at only 22%. I say only in air quotes because 22% still beat the S&P 500, which did an amazing 16.8% in that time period. Now, about a year ago, I did a video called Watch Me Buy $450,000 of Dividend Stocks, and two of the stocks I bought in it were 85 grand worth of Exxon Mobil and Chevron. I like doing videos like that so you can see what and when I'm buying, as well as so you could see that I'm not BSing about investing. That's also why I showed you my portfolio returns and fidelity in a video I just did called my multi-million-dollar dividend portfolio, $90,000 plus of dividends a year, both to motivate and inspire people to stay the course with their investing, as well as to show you what I'm doing is real. Which reminds me, I'll never push you to invest in my companies, as my goal is for you to be an educated investor, not to mimic me. I'm happy if you invest in real estate or ETFs or stocks or whatever. I personally love dividends, but also love non-dividend stocks as well, and bottom line care about you living frugally and investing, so you too can eventually retire due to your investments giving you the cash flow you need. But I don't care in the least if you invest in the stocks I own. The stuff I buy trades at such high volume that my social media audience wouldn't realistically be able to move the needle on price, even if you all bought and sold exactly when I did. If you're not new to my channel, then you know why I love dividends and how my portfolio literally pays my bills and allows me to be retired, so the actions I take with investing aren't a joke, unlike this video. My dividends aren't some temporary hobby of mine. Okay, so why did I invest a material amount of cash into oil companies? I mean, aren't they a dying industry? Kinda. Aren't EVs taking over the world? Kinda. Isn't the future renewables? Kinda. Did I just get lucky that supply chains started improving after I did those buys? No, I knew it was inevitable that things would get better. Did I have inside information that a country would invade another country in Europe? Obviously not. So why did I ignore the guy who left me a note saying that oil would never go above $100 a barrel again when it fell under 20 bucks during the pandemic? Well, for some insights, let's look at this chart of crude oil prices in the top graph versus Exxon Mobil in the bottom graph. I like showing actual data because that's what should be guiding your investing decisions, not just your gut. Your gut has some value, but I recommend you don't ignore data. Okay, so you can probably see how Exxon's stock price tends to follow what happens with crude oil prices. Exxon's board of directors is now taking a bigger focus on evolving beyond oil, but for the foreseeable future they will probably be tightly coupled with crude. The pandemic hit us initially in the end of 2019 and in early 2020. Investors saw that lockdowns started happening and travel was getting restricted, and many knew that there was a high probability of oil demand plummeting, and sure enough, oil prices dropped. Then in early March, Saudi Arabia initiated an oil price war with Russia, triggered by a breakup in dialogue between OPEC and Russia over proposed oil production cuts in the midst of the pandemic. This initially caused oil to drop even more to some of its lowest points in history until the possibility for oil production cuts stopped the bleeding in prices and things started turning around. Of course, as oil fell, the oil detractors kept saying, "See, I told you oil was dead." Here's a graph that shows the main stages of asset bubbles, which is a similar path that often happens with stocks driven by overzealous investors. So smart money usually invests in the early phases before everyone else. Then after them are the institutional investors who often also jump in early before something takes off, and all that buying acts as a catalyst to push it up. As it goes up, then the mania phase happens, where everyone and their brother decides to get in as FOMO takes over, so that's when the general public retail investors like you and me often decide that we want to get in, which is often in the greed or delusional stage before things start heading down. So kind of like right now, where people that were sitting on the sidelines with oil are now FOMOing in, which is also a sign of when things may start going back down. That doesn't always happen, but it's quite common. Then as things drop, the people who just bought at highs understandably freak out and sell, usually near the bottom, which again is when things tend to turn back around. Buy high, sell low, do bad, quit. Another classic mistake I see repeatedly are investors who make decisions solely based on stock price. They assume a stock is undervalued if it's fallen 50% without actually looking into why it fell. Was it because key revenue streams have been lost and EPS is falling? Has their business been disrupted? Or is the public overreacting to something? I was confident that oil had fallen more than was rational. People were acting like the world was ending and would never recover. Oil was so hated at the time that tankers couldn't even give it away. But the best time to invest is when something is out of favor and is overly disliked by investors. 3M is a good example of that right now. Sure, there's litigation risk, but I think that's overly pushing the price down these days, presenting people with an opportunity to buy. Telecom is another example that's disliked right now. Anyways, because I felt oil was irrationally sold off, I decided to buy as I was confident that supply chains would eventually improve. Oil isn't a dead industry, and while it does face a lot of headwinds, I know how reliant we still are on it and calculated that oil stocks were trading under their intrinsic values. At the time I was transitioning into retirement living off dividends, and more oil stocks fit nicely into my overall income needs. I think if you're someone who doesn't need the income from oil and you got in low, then getting out now makes some sense. If you are someone who is using oil for income and don't plan to sell, then staying in a holding pattern is reasonable. But what I'd be concerned about are people who are jumping in oil right now. They're chasing the trend after the boat left the dock already. Sure, it's possible oil could keep running up, but locking in your gains for a good profit at a strong peak might be worth doing, especially if you've been wanting out. It all depends on you and your beliefs and needs and risk tolerances. I don't invest in oil in my kids' accounts because while I believe oil will provide me with income for my life, I don't see oil having the growth profile that I want for my kids. I'm pretty confident we will continue to see fluctuations in oil prices like we've seen for decades, with periods of it being high and low, though the macro headwinds against it are stronger than the macro tailwinds pushing it forward, thus that's why my kids don't own it. Of course, emerging markets will drive up demand in some regions, but overall oil isn't compelling enough for me to push my kids into it, thus instead focus more on tech for them. But it's oil, so anything can happen in the short term. Wars, OPEC, so many things can make oil go wonky, both up and down. Okay, since you made it this far in the video, I'll penalize you with another dad joke. So what did Chris Rock find on his face this morning? Fresh Prince. Boom, timely humor for the win. Anyways, my investing strategy is one where I tend to focus on acquiring dividend stocks, not selling. I've given reasons why I'd sell, but short-term stock price fluctuations generally aren't one of them. My portfolio income keeps flowing in and usually trends up, just like my portfolio's market value trends up, with periods of down. I'll always be a long-term bull in regards to investing, and I basically don't care what happens in the short term. Some of my positions are more slanted towards appreciation, and others are more towards income. My strategy doesn't need me to quickly get in and out of positions. I prefer the power and simplicity of just buying, holding, and buying more with only occasional sells. When oil was falling, I read comments about how Exxon needed to cut their dividend. But their smart management team had built up a strong enough balance sheet for a rainy day. They weathered the storm without cutting their dividend, and ultimately managed to turn the corner into record profits, proving all the naysayers wrong. They did a small token dividend increase to keep the aristocrat streak alive, and I wouldn't be surprised if we see a more material dividend hike in our near future, though politically there might be too much pressure to do so. Part of the reason why I like single stock investing is that I can capitalize when I feel the market is being irrational. Anyways, let's get back to that sector performance graph, but this time I'll sort it based on 10-year returns. Now we see technology at the top with 466% overall returns, and we see energy as the worst overall sector at only 11% returns. This view helps explain part of the reason why I don't advocate for oil in my kids' accounts and am bullish in tech, because I'd expect the next 10 years to look somewhat similar as the last 10, which is why tech is the largest sector weighting in my portfolio. We can also see that the S&P 500 has had 225% returns over the last 10 years, which is why I think that most folks should just invest in it rather than pick single stocks. Speaking of the S&P 500, my hope is that it trends sideways for a decade, as that will lead to a more sustainable overall market. I mean, the markets average about a 15 PE, and the higher we are above that amount, the more likely it becomes that things will correct, and material crashes often cause people to panic sell and even quit. I'd rather avoid all that and just trend flat for a few years so that the companies can grow into their earnings while prices stay neutral. Like right now, we see that the S&P 500 is at a 24.78 PE. That's high, but the good news is that overall PEs are trending down lately as earnings go up and prices stagnate. I like the market to be more rationally priced, and I'm confident that we will trend back to a 15 PE long term. Thus, if we can trend sideways for a few years and business profits keep trending up like they normally do, then once again we'll be back to that normal PE average. Corporate profits go up around 8% a year on average, which means that every 9 years they should double. That also generally means that the stock market should double every 9 years as stock prices trend towards earnings. That was something Lynch observed. So you've got to love EPS trending up because stock prices follow earnings over the long term. Here's an example of how earnings trend over time. The red and blue lines are S&P 500 average EPSs. The shaded areas are when we had recessions, which is when business profits dip and EPS falls. Here's a similar chart, but now it has the S&P 500 overlaid over EPSs. What you see is that in the short term, stock prices get jiggy with it, but in the long term they will hitch along to EPS trends. Double word score on that one. So invest in companies that have growing earnings and you should reap the benefits in the long run. You can become a millionaire if you invest in solid companies over long periods of time. But you don't want to gamble on penny stocks. Sure, 1 in 100 people get lucky on some crap stock, but if you want to gamble, go to Vegas and at least get lucky. And do some gambling too. And remember, what's the biggest difference between Thanksgiving and April Fool's Day? Well, on one you're thankful, but on the other you're prankful. Boom, final dad joke. Okay, now something important to hear. If a YouTube channel is seriously talking about putting money into penny stocks, I encourage you to ignore the advice. If a channel is promising you how to get rich fast, then maybe watch it for entertainment value but not much else. Those videos get clicks but are also often terrible investment advice. There is no guaranteed way to get wealthy fast. There is no fast way to live off of dividends. There is no guaranteed 10x stock. The reason I push a slow and steady route of investing into a basket of decent dividend stocks is because I've experienced how it works. It's a strategy that anyone can do and succeed at if they stay patient and consistent for a long period of time. Treat investing like a lifestyle, not a one-off event. Treat it like eating right or working out or putting effort into your relationships. It's something you start and never stop. I desperately want to get the word out about dividend investing because it's so important for people around the world to realize how they can improve their financial and thus mental health by investing over long periods of time. Your portfolio will thank you in the long run. Speaking of portfolios, M1 Brokerage has a promotion running for a free cash bonus for new accounts. The way it works is you click on my M1 referral link in the description of this video and then either open a brokerage account funded with $100 or open a retirement account funded with $500. Then you need to keep your money inside the new account for 30 days from the date of deposit to get the free referral cash. Make sure to check the details before you sign up to see how much cash they're offering when you watch this video. Okay, now I'd like to shout out my latest Patreon aristocrats who've signed up since my last video. So thank you Born Exit Left, and thank you Vision 360 Fire Financials, who actually runs a YouTube investing channel that I'll include a link to in the description below. Show them some love and subscribe. Aristocrats gain access to my Dividend spreadsheet product that I use in my videos, and get to be in multiple private channels on my Dividend Discord chat server, where I let my upper tier Patreons watch my videos before I release them publicly on YouTube, as well as they get to vote on which thumbnails I use for my videos, and of course they get more direct access to me. If you made it this far in the video, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Finally, I highly recommend that you join my free Dividend Discord chat server, which has thousands of dividend investors on it and it's growing all the time. Thanks for watching, have an awesome April Fools, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.